Chaos has returned to global financial markets, and it does not appear that there will be an easy fix this time. For the first 4 months of 2019, the mainstream media told us over and over again that a great deal of progress was being made on a trade deal with China and that negotiations would soon reach a final conclusion. But now it's become clear that those news reports were fake news. For a variety of reasons, the Chinese have been slow playing negotiations all along. Once they got the Trump administration to suspend the implementation of any new tariffs while negotiations were ongoing, the Chinese no longer had any urgency to reach an agreement. In fact, if the Chinese could have run out the clock all the way to the 2020 election, they surely would have done so. They would very much prefer to negotiate with someone else, and I think that President Trump has finally figured out that he was being played.
It's enough. Thank you. Thank you very much.
On Sunday, in a very angry two-part tweet, Trump announced he is going to slap China with huge new tariffs. For 10 months, China has been paying tariffs to the USA of 25% on $50 billion of high-tech and 10% on $200 billion of other goods. These payments are partially responsible for our great economic results. The 10% will go up to 25% on Friday. $325 billion of additional goods sent to us by China remain untaxed, but will be shortly at a rate of 25%. The tariffs paid to the USA have had little impact on product cost, mostly borne by China. The trade deal with China continues, but too slowly as they attempt to renegotiate. No. In response to Trump's angry tweets, the Chinese suggested that they may cancel this week's negotiations. Chinese Vice Premier Li He had planned to bring a large delegation to Washington on Wednesday to hash out a trade deal, and there'd been talk in recent days that something resembling a deal could result. Instead, two sources briefed on the talks said the Chinese side may back out of this week's negotiations. That was pegged to Trump's new threats, they said, which abandoned a 6-month truce after Beijing waffled on some previously discussed commitments. And according to reporter Edward Lawrence, the negotiations have now officially been cancelled. Chinese Vice Premier Li He has cancelled his trip to Washington this week for trade talks following a tweet by President Donald Trump threatening more tariffs because the talks have moved too slowly. Needless to say, global financial markets did not respond well to this news. For most of the year, hope that a trade agreement was imminent had lifted stocks, but now that hope appears to be gone. In Asia, the major Chinese markets were all down more than 5% overnight. The Shanghai Composite fell 5.58% to close at 2,906.46, while the Shenzhen component dropped 7.56% to finish at 8,943.52. The Shenzhen Composite also fell 7.381% to close at about 1,515.80. The CSI 300, which tracks the largest listed stocks on the mainland, declined 5.84% to 3,684.62. Over in Hong Kong, the Hang Seng Index slipped 2.90% to close at 29,209.82. Hong Kong listed shares of Chinese telecommunications equipment company ZTE plummeted 8.82%, with the company being caught in the crossfire as Beijing and Washington spar over trade. Its Shenzhen-listed counterpart also fell 9.98%. The MSCI Asia X Japan Index tumbled 1.76% as of 4:12 p.m. Hong Kong, Singapore time. The offshore Chinese yuan also declined to 6.7790 against the dollar, From highs of around 6.72 last week, its onshore counterpart changed hands at 6.7655 against the greenback from around 6.73 last week. And oil prices immediately began falling as well. Oil prices tumbled on Monday after U.S. President Donald Trump said he would sharply raise tariffs on Chinese goods this week, risking the derailment of trade talks between the world's two biggest economies. U.S. West Texas Intermediate crude futures were down 67 cents, or 1.1%, at $61.27 per barrel at 7:20 a.m. Eastern Time. That's 11:20 GMT. WTI hit $60.04 earlier in the session, its lowest since March 29th. Brent crude futures fell 58 cents to $70.27 per barrel. Brent earlier hit its lowest since April the 2nd at $68.79. Trump said on Twitter on Sunday he would hike U.S. tariffs on Chinese goods this week, pulling down global financial markets, including oil futures. Dow Jones Industrial Average futures dropped 457 points as of 8:32 a.m. Eastern Time, which implied an opening decline of about 440 points. S&P 500 futures lost 1.5%, and NASDAQ 100 index futures dropped 1.9%. Shares of Apple and Caterpillar dropped more than 2.6% in pre-market trading on fears of a trade war. Chip makers were especially hard hit, with Nvidia and Advanced Micro Devices losing more than 3.5%. The sharp move down sent the SIBO Volatility Index surging. The VIX, which is considered to be the best gauge of fear in the stock market, jumped to 17.24 from 12.87 and touched its highest level since January the 30th. Unfortunately, this is likely to be far more than just a temporary setback for the markets. Unless a trade deal can be salvaged somehow, things are likely to get very interesting quite quickly. Now, according to one top expert quoted by CNBC, this has all the makings of a complete disaster that could lead the stock market to crater this week and send those external risks to the U.S. economic outlook soaring. Another turn of the screw tied to Sunday from the president's hardball tactics with the China trade talks, and his pair of tweets looked like they could unleash a sharp stock market correction, said Chris Rupke, chief financial economist at MUFG Union Bank, in a note. For weeks now, markets have been lulled to sleep on the U.S. trade war with China, thinking an agreement was imminent. No more. This has all the makings of a complete disaster that could lead the stock market to crater this week and send those external risks to the U.S. economic outlook soaring, he added. Could this be one of the triggers that pushes us over the edge and into the economic abyss? Even without the collapse of trade talks with China, we were definitely heading toward a recession anyway. I really like how economist John Williams made this point during a recent interview with Greg Hunter. We have a recession in place. It's just a matter of playing out in some of these other funny numbers. The reality is on the downside, where you have mixed pressures right now. People who are really concerned about the economy right now, and that includes President Trump looking at re-election. He's been arguing that the Fed should lower rates, and I am with him. The Fed created this circumstance. They are pushing for the economy on the upside because they want to continue to keep raising rates. Banks make more money with higher rates, and they're still trying to liquidate the problems they created when they bailed out the banking system back in 2008. Williams strips out all the financial gimmicks in his work that make things look better than they really are to give a true picture of the real financial health. Take, for example, the recently reported good news of the trade deficit narrowing. Williams says, what we saw was the very unusual narrowing of the deficit. Now, that's generally good news. But if you look at why the trade deficit was narrowing, It wasn't that we were having new surging exports. Instead, we were having collapsing domestic consumption. People weren't buying things. People were not buying goods. So the imports were falling off, and that narrowed the deficit. That is not a healthy sign. The last time you saw something like that was the beginning of the Great Recession, 2008 to 2009. We still haven't recovered from the Great Recession. If rate cuts don't happen soon, is the economy going to tank? Williams says the economy is tanking, and I'll contend it already has, although we've not seen it in the GDP reporting. The ultimate thing here is that you have a collapse in the dollar. I'm talking about a hyperinflationary collapse. Your purchasing power becomes worthless. What you have in gold or canned goods or real estate, that'll be your assets, hard assets. In closing, Williams says the underlying weakness is with the consumer. Until the consumer gets turned around, you're not going to get a fundamental change in the economy. The economy is going to get weaker. The Fed is going to recognize that, and they probably already do recognize that. They don't want to lower rates, but I think they're going to have to. I would look for easing by September, and maybe quantitative easing, money printing, as the economy continues to deteriorate, as it seems to be doing. I know the numbers are not there yet in the headlines, but watch out. The first few months of 2019 have been surprisingly quiet, but now events appear to be accelerating in a major way. So, hold on tight, because it appears that a very bumpy ride is ahead. This is one of the reasons why I get so frustrated with the financially illiterate politicians who insist that everything will be just fine if we just tweak our current system a little bit. No, everything is not going to be just fine. In fact, we have perfectly set the stage for the worst financial meltdown in human history. At this point, nobody has put forth a plan to fundamentally change the system, and there is no way out.